Good evening, students. I am Shankaramurthy, Senior Chartered Accountant, and I have been lecturing for Corporate Finance and Risk Management at a private institution for 16 years. So I am sure most of you all be knowing me. Today we are going to take up the valuation of shares chapter. I am sure all of you all got the study pack. So if you can refer to the study pack chapter 5, which on valuation of shares. If you take the financial management syllabus, my opinion is the financial management, most of the areas have a linkage to the valuation of shares, right? In the sense that principles that you learn from valuation shares help you to understand some of the other topics which are also connected to it. So we will discuss the valuation of shares. I am not going to take a long questions and discuss, but all the main valuation methods we will be discussing today. 2 hours we are taking today to discuss the area. If you take the valuation of shares chapter 5, starting from the reasons for valuations. Why the valuation of business or shares is important. So you might see there are listed companies and unlisted companies. Listed companies, we all know in Sri Lanka, the companies which are listed in Colombo Stock Exchange have share price. So the share price you can obtain from the listed market on a daily basis. So listed companies market value, truly speaking, it's available, readily available. So the price is readily available, so anybody can understand what is the value of that company. However, unlisted companies, which are mostly the private company or even public companies, which don't have a listed price as such, there you need to find out the value of that company basically using various methods of valuation. That's what we are going to discuss today. Listed company, as we mentioned, you have very clearly market value. So you don't worry much of valuing that share, but still we will see why you may need to value the listed company shares, because these market prices are subject to the trading happening in the stock market. Whereas if you are going to buy a company's majority stake, it can be 20%, and if you are to have a controlling stake, it can be 51%. So 51% if you are going to buy a company, the market price what is traded in the listed market, it may not be the right price or the fair price. So what do you do then? Then you need to do a valuation of the shares or the company using different methods. So even the listed company, we need to do the valuation mainly because those companies can be under takeover or somebody can be buying the controlling stake. So therefore the listed company also we will do a detailed valuation using different methods of valuation. Unlisted companies, since they don't have a value, you need to first establish a value. What is the value of that? Even to understand how much the value of the company. Then we might say, for example, transfer of shares. If you want to transfer of shares for unlisted company, you need to know what's the value of the shares. Then if you are talking about mergers or acquisitions, it can be applicable even for listed company. That's why I said, like, even for buying of any company, it will be applicable. For unlisted company, anyway you need to do, because there is no way that you have understand your value, mergers or acquisitions. Even some cases in Sri Lanka may not be at present for the tax purposes. Even to understand how much the tax the company needs to pay, you may have to value the company using a valuation basis. So there are various reasons we will have to value a unlisted company or listed company. So even the listed company, some of the things what I am discussing here will be used to value that company. Okay. I am just taking through because it's anyway in your study pack. So you could go through the study pack to read out all those. Then coming to the different methods of valuation. If you are going to value a company, there are various methods. Just get into your mind that, okay, you are going to value a company. That company valuation can be calculated, or value can be calculated using assets based or earnings based and cash flow based. So you could see that the valuation methods, whatever we will be discussing over 2 hours, will be falling into either assets based or earnings based, cash flow basis. So maybe once the chapter is done, you might see that each method where it fit on, whether it's asset based valuation or earnings based valuation or cash flow based valuation. So on the asset based valuation, the key valuation method will be net asset basis of valuation. We'll come to that. Then earnings methods of valuation, it's the PE method of valuation or earning yield method of valuation. Cash flows, you could be using dividend cash flows or free cash flows. So you would see that there are various methods we will be learning. Those either fit on to assets based or earnings based or cash flow based. These are the key methods of valuation we will be discussing today. Then starting from the first method of valuation, which is net assets basis of valuation. So what is this net assets basis of valuation? You might see that in the chapter 5, page 101, it basically continues for a couple of pages, which based on net asset basis of valuation. So what is the value of a company using net asset basis? Simply it's your balance sheet. If you take any company balance sheet, your net assets is the value of the company, or shareholder funds. If you take balance sheet of the company, shareholder funds or net assets. So please note, simply you take your balance sheet of a company and see the balance sheet, how much the net assets are or the shareholder funds are, which is the value of the company. Now you might think, okay, these are just accounts. Yes, true. Based on accounts, we are valuing the company, that net assets form the value of the company. If you take the balance sheet is subject to accounting standards, right? Or your financials have been prepared based on accounting standards, so it reflects the fair value of the financial assets or all the assets and liability using whatever the standards you apply. From the financial management point of view or the valuation point of view, the net assets should be your balance sheet value plus or minus, you might have to do certain adjustments. So please note, even your net assets value what you have in your balance sheet could be a value of the company, but there can be some adjustment you may have to make. So what are adjustments? What are adjustments you would do? One, we will say your property plant equipment or your fixed assets. If your property plant equipment in your balance sheet is not reflecting the fair value or it has not been revalued over the past, then you might use the revaluation adjustment. Your balance sheet PPE is not properly reflected the fair value, so you may need to do the revaluation adjustment. Second, you take your inventories or debtors, which could be needed to be adjusted for any provisioning or any impairment. So please note, your inventories and debtors in your balance sheet may be needed to do a adjustment for provisioning or impairment. So it is possible. So you could do that adjustment and then find out what is a realizable or in a sense more a fair value of your inventory and debtors. Maybe some of the liabilities, I would say even contingent liabilities. You need to find out whether that contingent liabilities needed to be accounted or adjusted for. You have to see, sometimes your company might be having a legal case where you have a chance of failure. So you may need to do the adjustment when you are valuing a company, especially a person who is going to buy the company, targeted company. He will want to know, okay, truly what's the value of this company. That liability needs to be sometimes accounted for so that your value is reasonable. Similarly, you might have a compensation case. The employees who have left the company had gone and taken a labor tribunal case, and then your company may have to pay. So it can be inland revenue where your taxes needs to be paid, where you are not accounted, but there is a chance of you failure. So that also needs to be booked in your books. So these are some of the adjustments you may have to look at for the liability or contingent liability purposes. So please note, even though your balance sheet net assets is simply the value of the company under this basis, there can be few adjustments we would like to do based on the further information available on the marketplace or even the exam questions. So one is revaluation adjustment, second one is provisioning or impairment for inventories and debtors, third it's about contingent liability. There are other information which is the intangible assets. Intangible assets. You might want to know whether we need to adjust. We need to adjust this value. Generally, intangible assets, it can be your patents, brands, copyrights or goodwill, any of the intangible nature. Maybe not in the books. Your balance sheet does not have. But if the intangible what you have, or even if you have it in the books, whether that intangible assets have a realizable value or it's a marketable. If it is marketable, then you can consider that part of your value. So please note, this is one of the things the examiner test generally. Intangible assets, if it is in a balance sheet or even if it is not in balance sheet, if that is realizable, if it is realizable, you can take or add it to the net assets value. If you have it in a balance sheet, goodwill for example, but if the goodwill is not realizable, then what do? You remove that goodwill and value the company. You have to remove the goodwill. Similarly, even you might have brand value or the patent value in your balance sheet. If that patent value does not have a value in the market, nobody buys that, then you have to remove that value from your net asset valuation. So please note, other than these three, intangible assets, if it is realizable, you can consider part of valuation. Otherwise, you can exclude the intangible assets from your valuation. So please note, intangible assets, if realizable, you can take it. If not realizable, please don't take it. So these are the few of the adjustments. Maybe you can go through the chapter, so get the further understanding. But what I am trying to tell you is, it's simply your balance sheet net assets. Sometimes you may have to do adjustment for few of the areas. Okay? I believe that you have covered. Then again, on the net assets based of valuation, you might see that page number 103, page 103, they talk about the choice of valuation basis. Under net assets, there are three valuation of basis. Under net assets basis of valuation, there are three choices. One, historic basis. Second one, replacement basis. Third, realizable basis. So please note, even though it's net assets basis valuation, under that the assets value could be one of the three. One is historical. What is historical? All of us know, it's purely your balance sheet net assets. That is based on your accounting standard, whatever the way you have done, values, that's historical basis. Replacement basis is where if you are going to replace, say, property plant equipment, if you are going to replace the property plant equipment, what is the replacement value of that? Maybe this building, you might say the building value in books is, building value you have book is 100 million. But the same building, if you are going to replace in the marketplace, similar building, it is 200 million. So you may have to consider this 200 million as your value of the PPE under replacement basis valuation. Again, it's net assets. The item one by one, you take the replaceable value of the same item. Realizable value basis is where you would consider only the realizable value in the market if you are going to sell that asset. So if you take the same building, the building what we are talking 100 million, building 100 million, your realizable value may be 80 million. It's not 200 million, it's 80 million. If that is the case, you take the 80 million as the value of that asset. So please note, on a net asset basis of valuation, if it is just accounting basis, historic basis, which all of us know the accounts are in historical basis, so you can take that. Sometimes the examiner might say that, okay, you are given some replacement basis values of certain assets. Then you consider those values as the value of the assets, one by one. Third, realizable value, where the same asset which may be having book value of 100 million, but realizable value is only 80 million. So you take that realizable value, not the 100 million for that asset. So these are three bases. So depends on the examination question, you may have to look at this basis. Otherwise, you just take your net asset basis and do the adjustments what we talked about. Then in terms of net asset basis of valuation, net asset basis of valuation, what is the plus and minus? Since we are learning, there are many methods there. One method, first method we are talking net assets. What is the plus and minus? Net asset basis of valuation gives you the minimum guaranteed value. Minimum guaranteed value. What do you mean by minimum guaranteed value? If you say your company is worth 100 million rupees net assets, your balance sheet has net assets of 100 million, and you say that's the value of the company. That value is minimum guaranteed. Why? You could be able to sell one by one assets and realize that value and say the shareholder, this is your value. So this is the minimum guaranteed value. When you look at the other methods, those are mostly dependent on the future related stuff. So you may not realize that for sure. But here you are sure of realizing most of the time because you have minimum guaranteed value where you identify assets. For example, building 100 million, definitely you will get the 100 million. Right? Similar inventory, debtors, cash balances, you have value. That values can be realized. So that's the minimum guaranteed value under net asset basis of value. Second, it is easy to calculate. Comparatively, other method when you compare, easily calculatable. You can take the balance sheet and say that this is the value of the company. You don't need to make any assumptions or future forecasts, or you don't have to estimate things. You don't need to do. This is easy to calculate. So these are the pluses. Minus. The issue is it does not look at your future cash flows, earnings, potential brand name or the brand value, and your what you call location benefit, right? There are many things, right? Your future related stuff you don't consider under net asset basis of value. It's blindly take your balance sheet and say this is the value of the company. Whereas any business in Sri Lanka or anywhere you say the value of the business or value of the company is not based on the balance sheet assets, it's based on your future related. So what is the potential you have? So this is not considered here. And further, it looks at, net asset doesn't look at time value of money. The cash flow basis of value, what we discuss later, all consider time value of money, but here net asset basis does not look at time value of money. So please note, it has pluses, it has minuses. So when we discuss different methods, you will realize that which is a better one. So please note, this gives you a minimum guaranteed value. This is a very important name. Why I am saying, even if you say you are going to value a company using different methods, this method is giving you some understanding that this company is worth so much, and you are sure of getting that money. Right? That's how the feeling you should be getting, minimum guaranteed value, compared to other methods that we talk about. The main negative is it does not look at future. Right? All of us, you say as a human or you being a professional, you will realize that you have value. You have value. So what's your value? It's your balance sheet is maybe your net assets today, assets and liability you take today. So assets and liability when you take, your value is say X amount. That is your value, the value of yours. But is it your value? No. Your value is very higher than or very much higher than what you are now. It's actually based on your future. Future, what you are going to do. Now, especially you guys, you are very young, chartered accountant to be. So, when you see yourself, you may be at a 20-25 age, right? You are very young and your amounts of salaries are small at this moment. So, you think, okay, my value is only limited to your mind. What you think like maybe small amount. But your value is not that. You are unlimited potential person, right? The future cash flows of what you're going to generate is huge. So when you look at the future cash flows, present value or earnings what you can make it, your value is very much higher than what you think at this moment. So that's, please understand, that's the problem of net asset based evaluation. Net asset based evaluation is what is the value of your bank balances or assets what you have today context. So maybe a 23, 24 years person, you might not have millions rupees worth of assets in your name. Right? Unless if it is inherited from someone, you don't have it. So it's basically a small amount of assets you have. So you might think that's my value. That's your net assets. It's not, because your net assets is smaller, but your actual value is all your future related. So please get that point. So that's your first method of valuation, net asset based evaluation. We just looked at it. Second, we move on to the earning based. Second one, earning based valuation. Earnings based valuation. What's earning based valuation? Main valuation method is, we call it price earning ratio. Price earning ratio based valuation. Price earning. So how do you value? Market value per share, if you are talking about per share, one share value, your earning per share multiplied by PE ratio. Earning per share into PE ratio. If it is same thing, if you are valuing the market value total, entire company shares, you are valuing total value, that is profit after tax multiplied by same PE ratio. So this is the method of valuation, PE ratio method of valuation. So what is PE ratio? First place, price earning ratio. Price earning ratio, it's basically the relationship between market price and earning per share in a given context. So if you take any company, you will have a listed price and that company will have earning per share. So earning per share and the listed price have a relationship. For example, you will see that earning per share is 10 rupees and a market price of the same share 100 rupees. So your PE ratio, price earning ratio is 10 times. Price earning ratio is 10 times. So it gives you relation between earning per share and market price. Your 10 times of earnings is the market price. 10 times of earnings is the market price. So please note, from the calculation point of view, it's your earning per share into PE ratio or profit after tax into PE ratio. PE ratio means it's a relation between price and earning per share. You might little confuse yourself because your formula market value also earning per share into PE ratio. When I say PE ratio, it's actually price earning ratio equals to market price divided by earning per share. So it's a variable changing places, you will understand. But the PE ratio can be, it's a relation between earning per share and market price. That PE ratio, you might see that available, PE ratio can be available for company PE ratio company P ratio, it can be available for industry P ratio, and it can be available for market P ratio. The price earning ratio, that is the market price and earning per share of one company, could be available for the company only. If you take X company, market price and earning per share as a relationship. So you can see a P ratio for a company. Same time, you take a banking industry, or maybe the hotel industry, or the hospital industry, or telecommunication industry, any industry you take. That industry, taking all the companies in that industry, you can look at their earnings and their market value and see what is the relation between that. So you could come out with a relationship between those two as the industry P ratio. So you will see for the banking industry separate P ratio, you will say the telecommunication you have another P ratio, maybe a diversified group like John Keys, Ailey, and Spence. Diversified groups will have a separate P ratio based on those companies which are there in that sector or the segment, that company's earnings and the market value, you compare the relationship and come up with the P ratio for the industry. The other one is a market P ratio. Market P ratio is all the companies in the stock market, 290 odd companies, all 290 companies, market value and their earnings, what is the relationship? Entire market, 290 odd companies, total earnings and the market value, what is the relationship? That shows the market P ratio. What happens in normal context in international environment, you look at the market P ratio of your country with the other country's P ratio. In Sri Lanka at this moment, market P traded 10 times. That means if you say your earnings of your company is 1,000 or 1 billion and your P ratio is 10 times, your market value of the company is 10 billion. That's based on this valuation. 1 billion earning, profit after tax is 1 billion of your company, and P ratio of the market, if you are taking 10 times into profits, 10 billion. So that basically gives you the idea what is the value of the company using market P ratio. Please understand that your P ratio can be company specific P, industry specific P, market specific P. So generally in the environment of stock market, you will be able to understand and get P ratio of the company or industry P and market P. And CSE website, that is www.csc.lk. You can go through the website to find out what is the P ratio of the industry. Specific industry, you can find out what is the P ratio over the past it's been trading at. Today or maybe last Friday, the P ratio would be 10 times, the average of 10 times. So that basically is the market P. I'm not talking about one specific industry. 20 odd sectors we have in industries, but market P ratio is 10 times. So please note that this is about the P ratio valuation. Formula wise, it is a simple thing, earning per share into P ratio or profit after tax into P ratio. But the PE can be company PE, industry PE, market PE. So that's basically you have to keep in mind. Market PE generally you compare with different markets worldwide and see that okay, how the Thailand PE ratio is, how the Singapore PE ratio is, how the India PE ratio is. You can compare the markets and see which markets are trading how. Industry, different industries you can say okay, now at this moment you might see that certain industry PE ratio can be higher than certain industry PE ratio. So we will discuss the PE ratio indicates and characteristics, we will discuss that. So that's industry PE related. Company specifically we can say the earning per share of the company and market price and see what the PE ratio is. Then there are some characteristics of P ratio. Characteristic of P ratio. If you see that you are seeing a company or an industry or a market having higher P ratio, high P ratio, what are the qualities or characteristics? Higher P ratios, qualities or characteristics, what are the things? You will see there are certain characteristics attached to higher P ratio. So what are those? the company or maybe industry, if you see the earnings are stable. If you take one industry or one company earnings over the past few years or even next few years, you realize that the earnings are going to be stable. If the earnings are going to be stable, for sure that company or the industry will have higher PE ratio. There are certain times you will see certain companies or industries are very strong in their earnings. They are very strong, stable for long period. They don't just go up and down. They remain to be the same or it is growing at a slight phase. So you will see the earnings are stable. That is one indication, higher PE ratio. Sorry. Second, you will see that risk is lower. Comparatively, that company or the industry risk is lower. If you feel that industry or company's risk is lower, that also will have a higher PE ratio. Especially companies like diversified companies. Let's say John Keys. John Keys is having various business environment or businesses, various segments. So their risk is minimized because they don't depend on one industry or one products and services. They have the financial sector, they have the hotel sector, they have banking sector, you have retail sector, the key supermarkets and other foods items. So you will see that there are various businesses, they don't depend on one. So one business, maybe the tourism sector, if you take today's context, tourism sector may not be doing well. Because everybody knows there is a problem, so people don't come. So tourists are not coming, their business is not doing well. But there are other businesses, they are doing their businesses operations properly. So in that case, as a group, your risk is nullified or offsetted by other business environment. So risk is lower mean your P ratio is higher. So if you take a company, A company and B company, A company is single product company. B company is diversified businesses. If you take the risk, here A company high. Why? You are depending on one product. B company less or lower. Why? Because your risk is minimized because of diversifying a business. So the higher PE ratio you will observe in where the company has risk is lower. So these diversified groups will have a higher PE ratio than one product dependent company where the PE ratio could be lower. Third, you would see that the company's management is good. Right? You would realize that certain organizations in the market have kept their reputation very high. Corporate governances, practices, various management expertise involved in the company. So the management is good. So then people know that this company, whenever they say something, there is some credibility. There is a value in it. In that case, your PE ratio could be higher. It could be higher compared to others. Even though formula basis you can't connect it, but truly there is some value you give it for their management, good management. Then you will see that the risk management practices. There are organizations which have good risk management practices. So if you see that company has good risk management practices, that company will have a PE ratio than a company which has a lesser risk management practices. So that is also one indication when you say higher PE ratio, that company has very good risk management practices. So earnings are stable, risk is lower comparatively, market or the management is good, risk management practices are good risk management practices. All these will highlight that company could have higher PE ratio or the industry could have. Then the other thing is future growth is strong. Future growth is stronger, right? If you see that company business has a very good future, very stable or the growing future, then you know that that company will have higher PE ratio. So there are industries, there are companies, everybody knows that this company will do very good. Over the period of time they will perform very well and they have very good potential to make money. in that case, they are higher PE ratio. They will be valued, the company will be valued at higher PE ratio than a company where there are lot of doubtfulness, where this company can survive in the future or they will maintain the earnings, all that questionable is there. So if that there is a question, it will be having lower PE ratio. So please understand, when you are seeing a company having higher PE ratio, these could be some of the characteristics you will see that in that company. If you have some company having this kind of qualities, then you can value that company with a higher PE ratio, So that's something to note. Then you might see that the company could be a listed company. Unlisted company could be valued at a lower PE than the listed company. We need to keep in mind, right? If you take a private company, you are going to value a private company. Same business, you might have a listed company. Same business, you have a private company, a listed company. So private company, listed company you will value at PE ratio of 14 times. Private company, you cannot value using same PE ratio. Why? Private company and listed company, what is the difference? Big difference is you cannot marketable. You cannot be marketing your shares or you cannot be realizing your monies. So there is an issue with your shares. Your shares cannot be easily gone and told to somebody that can you buy these shares. Private company you cannot do that, but listed company, Monday morning you call the broker, can I sell my shares? He will sell it. So it's marketable, realizable, its liquidity is very high. So this listed company shares you could value maybe at a 14 times, same business, but status is private company. In that case, you are valuing at maybe not 14, less than 14, say example 12 times. So please note, very important, these are the things, some of the things examiner test. Private companies and listed company, if you are going to value, you cannot use same PE ratio. Private company you have to value using lower PE than the listed company. For example, say profit after tax. Private company was 100 million, listed company was 100 million. Same business, both are same business. It's a private company status, these are listed company status. These are 100 million, these are 100 million. But your value, market value, this is 100 million profit. So you might think, okay, they both will have same value because both are 100 million. It's not. 100 million, 12 times, you are talking about 1.2 or the 1,200 million you will have. Same thing here, 1,400 million. Now see, these two companies are in the same business, same profit levels, but the value is different. Why? Listed company, private company. So please get the point here. The examiner could be giving in your case study where they can talk about a case which is a private limited company, but he may use the similar information or proxy company information which is a listed company information. So listed company information, you will see the PE ratio is 14 times, but unlisted company you might not be able to use same 14 times, you have to reduce it. So your PE ratio will be say 12 times or maybe lesser than that. So it's always a kind of a judgment call. Or maybe if it is a practical case, I would say, you can go to the stockbrokers or market, they will tell you, okay, you need to make a 20 to 30% adjustment or downward adjustment for your listed company PE to value unlisted company. So even though same profits, 100 million both companies, but values are different. One is 1.2 billion, other one is 1.4 billion. Why it's so low? Simply because it's a private company. Why the private company? What is the problem? The private company shares do not have marketability eligibility. That means they cannot sell the shares anytime. Listed company, you can sell the shares anytime. So that's a big difference. So therefore you cannot value the same business private company at the same PE ratio. You have to reduce the PE ratio for that purpose. So keep that in mind. One of the adjustments you may have to do. That's why I said good high PE ratio companies will have certain characteristics. One of the characteristics is the listed company compared to unlisted company. Okay. So please note this. So the PE method of valuation, what we discussed, which is commonly used in the marketplace by the research people or the stockbrokers or even the company which are planning to buy another company, use the P/E ratio. So please note that P/E ratio is very helpful in valuation, and which is very important value, which considers the total value also. So if you look at the pluses and minuses of P/E method of valuation, pluses and minuses, first thing, it looks at the total earnings of the company, total earnings of the company. It does not look at only a portion of the earnings or anything. It's about total earnings of the company you are taking. Second thing, it gives you total value of the company's potential, because sometimes you may not use the P/E ratio, you may not use the earnings of the past. You may use the future earnings also. For example, 2020 earnings or the profit after tax, say 1 billion. Maybe 2021 you might see your profit after tax is 1.5 billion. So the P/E ratio method can be using the future earnings also. So a market value equals to P/E ratio, say 10 times into 1.5 billion, that's the next year profits, then you are talking about 15 billion. So you could value based on future earnings also. Therefore that potential earnings also considered. So you have total earnings is considered, not the portion of the profits or cash flows, it's the total earnings. Second, potential earning, sometimes you will value based on the company's future earnings, that's next year earnings, and you value the company. So that's the second thing. Third, it basically considers market environment related aspects. Market aspects, for example, if you are talking about unlisted company valuation, you will take the market P/E ratio or the similar company listed P/E ratio and do the adjustment and value the company. So there is a market aspects also you considered in your valuing a company. Minus, P/E ratio minus is, sometimes you will see that it's difficult to get similar company P/E ratio. You will see there could be a private company, which is involved in certain, say, software development company. If you don't have a listed company in the market, you may not be able to use the P/E ratio. You cannot just value based on 10 times or 15 times. You need to have a similar comparable P/E ratio. Then you can do some adjustment, but you need to get the P/E ratio. So if you take, say, education company, if you don't have a listed company in education, how are you going to value it? You are an unlisted private company which is having a good education business, but you don't have a similar company listed in the market. So how do we take the P/E ratio? So you may have a problem with the P/E ratio. So this is difficult to get similar P/E ratio in the market. Second, there are judgment used in order to value a listed company. Judgment used. You may have to say, okay, this company, due to the characteristic the company has, you cannot use the present P/E ratio, you may have to do adjustment, upward or downward. That adjustments are judgments. As I mentioned earlier, listed company. Unlisted company, even if you have a listed company similar business, you may not use the same P/E ratio. You will say 14 times earlier what I mentioned, 14 times P/E listed company, unlisted 12 times. So you reduce the P/E ratio. To reduce the P/E, how much you are going to reduce? Is it going to be 12 times? It is going to be 11 times? It can be 10 times. So who decides that? So these are all judgments. So that is one of the weaknesses of this method of using P/E ratio. Right? Third, you will realize that sometimes the P/Es what you reflect in the market may not be representing the fair value or the fair representation. So it is the not unfair, it's actually The PE available in the market, PE not represent fair basis. You will see that certain time the PE ratio could be very lower, so you cannot use that PE ratio to value the company. So that is not representing a fair value. So then you may ignore the PE ratio and value the company on different methods. So these are some of the plus minuses. Total earnings considered in PE method of valuation. Potential earnings are considered. Consider the market aspects where a listed or unlisted company where you need to make adjustments. You will look at it. There's a positive sides of it. Minus, difficult to get similar PE ratio. You cannot get it from the market, similar PE ratio sometimes. Second, judgment use. For the adjustment, say example, upward or downward. It can be both ways. The adjustments needs to be done. Especially when you are talking about unlisted company valuation, you have to do the downward adjustment. And if you are going to buy a controlling stake of a company, you may have to do the upward adjustment. So these adjustments, what percentage you are going to adjust? 15 times PE in the market, you need to reduce it. By how much? 10%, 20%, 30%? Similarly, 12 times in the PE in the market, you may do upward adjustment. How are you going to do that? So this is simply a judgment, which is somebody can make it at different level and somebody can make it another level. PE not represent fair basis. When there are markets, crashing markets, where the markets are crashing continuously, the PE may not be a representative of the valuation. So you can't take that PE basis to value a company. So these are some of the observations you should have in PE methods of valuation. Third important method is the cash flow basis of valuation. Cash flows basis of valuation. Cash flow basis of valuation. Under cash flow basis of valuation, there are two types of cash flows. One is dividend cash flows. Second one, free cash flows. Free cash flow. So please note, there are two types of cash flows we are going to look at. Dividend cash flow method and free cash flow basis. Both these methods, the logic of valuation, or the principle or underlying concept, whatever you call it, the valuation basis goes on the basis of present value of future cash flow equals to your market value. Please note, your market value of the company is present value of future cash flow. This is the cash flow basis of valuation logic. Your value of the company today equals present value of future cash flow. That future cash flows can be one type of valuation, dividend cash flows, other one is free cash flow. So please keep in mind, this basically gives you the basis of valuation and the cash flow basis. Okay? Dividend cash flows or free cash flow. Present value of future cash flow. Then moving on to the dividend cash flow method under the cash flow basis. Dividend cash flow basis. Dividend cash flow basis. So dividend cash flow. So what is this method of valuation? It says your market value equals to present value of future dividend cash flow. Market value equals to present value of future dividend cash flow. So market value is based on present value of future dividend cash flow. So if your company is going to pay, say, 5 rupees for next many years, this is year 1, year 2, year 3, it goes till infinite period, these are your dividend cash flow. If a company is going to pay 5 rupee dividend for infinite period, market value, how do you calculate the market value? Present value of future dividend cash flow. If the dividend cash flow is constant for infinite period, it's a perpetual cash flow, constant perpetual cash flow. So present value of the future dividend cash flow equals to your dividend divided by your cost of capital or required rate of return of the investor. So please note, your market value, we call it market value ex div, that is current year dividend is excluded, equals to dividend divided by RRR of investor. RRR of the investor. So dividend divided by RRR of investor equals to market value under dividend valuation model, where the dividends are constantly paid for infinite period. Constantly paid for infinite period. Same time, if your company is going to pay, or some company is going to pay dividends with a constant growth rate, if the company is going to pay with a dividend constant growth rate, then your valuation will be market value x div equals to DO 1 plus G R minus G. R minus G. So these are things available in the study pack, right? If you want to refer the pages, you can look at the page. Page number 112, page 1112, page 112. Right, so you can refer that. Market value using dividends, where the dividends will grow at a constant growth. There is a constant growth mean each year the dividend will be growing at the same rate of growth. 5% growth mean entire future, every year 5% dividend will be growing. In that case, market value equals to DO 1 plus G R minus G. R stands for recurrent rate of return of the investor. Recurrent rate of return of the investor. G stands for dividend growth rate. Dividend growth rate. So please note, this is a formula to calculate market value x div. So this dividend valuation model, first one what we looked at, this is a dividend valuation model. This what we are looking at, a dividend growth model. Why? There is a dividend growth constantly. Here no dividend growth, it's a constant dividend for infinite period. There is another method. We looked at first one, constant dividend valuation. Constant dividend valuation is you will have a equal amount of dividend for entire future. So year 1, year 2, year 3, like that goes to infinite. For example, 5 rupee, it goes. It's a constant dividend valuation model. Second one, constant dividend growth model. Constant dividend growth model, where you will see that the dividends are going to grow year 1, year 2, year 3, like that it goes to infinite period. For example, if you say 10 rupee dividend, you have a 10%, that is 11 rupees. 10% growth. Again, another 10%, 11, 12.1. That is again 10%. So each year it will grow at 10%. If that is the case, it's a constant dividend growth model where the formula is involved, what we looked at earlier, you can calculate the value. Third is the two or three stage valuation model. 2 or 3 stage valuation model. Here we will value the company using simple logic, present value of future dividend cash flow. Future dividend cash flow. So you can see that in the you can take page number 113. There is an example where you can see that the dividend growth can be different growth for different period. For example, you will see year 1, year 2, year 3, you might say 10% growth. 10% growth. You can have from year 0, 10% growth for 3 years. After that, till infinite period, you will have 5% growth. So if you have 2 types of growth, you can value using simple logic, present value of future dividend cash flow. Present value of future dividend cash flow. So the example is given in the study pack, where you can value the share using simple logic, present value of future dividend cash flow. So first 3 years, no problem, you will know the dividend amount and you discount using your discounting factor. Year 4 onwards till infinite period, you will see the dividend is growing at a constant growth rate. Then we use the dividend growth model, what we learned for the second one, calculate the value and rediscount to bring it to year 0 and see the value of the company. So these are 3 methods we can use for dividend cash flow based valuation. One is constant dividend valuation, other one is constant dividend growth, third one 2 or 3 stages of dividend growth. Then please note the growth rate, dividend growth rate. Dividend growth rate, how do you find out? Dividend growth rate, how do you find out? There are 3 ways you can find out dividend growth rate. One is analyzing the past. Analyzing past dividend pattern. Analyzing past dividend patterns. Or analyzing future dividend plans. Future dividend plans. The company might be having a dividend plan, how they are going to pay dividend over the future period. You can look at it and say what is the average growth rate they are expecting. Or you look at the past 5 years of the dividends and see how the growth had been, average growth had been. Third, you can use growth rate equals to RB. So out of the 3, I would say the third one is more relevant from exam point of view. Growth rate can be calculated by RB model. RB model, what it says, this is your return on equity, this is your retention ratio. Retention ratio. So according to RB model, the dividend growth rate you can calculate by multiplying the return on equity and the retention ratio. What the model says, if you are going to retain profits, in order to invest in the business to earn more money, then you will see a growth rate. If you retain profits in the business and reinvest, that will generate more profits and more dividends, that means you will grow. So if you don't have a retention, if any company say, no, we pay 100% dividend payout ratio, 100% dividend payout ratio, 100% dividend payout ratio. If you are going to pay 100% dividend payout ratio, according to this model, it says you cannot have growth, no growth. No growth. Because logically, if you don't invest, you don't grow. I think that's a simple understanding. Whether you or company or the country, if you don't invest, you cannot grow. You cannot grow. So in order to grow yourself or your company or your country, you need to invest. So please note, in order to grow, you need to retain money and invest. Retain money and invest. So here the retention ratio multiplied by return on equity give you the dividend growth rate. So we can use that to calculate the dividend growth rate and apply it to the calculations. So please note, these are 3 ways you can calculate dividend growth rate. Third one is more relevant from exam point of view. Examiner may be asking you to calculate the dividend growth rate so that you can apply for your formula to calculate the value of the company. So this dividend cash flow basis also a plus and minus. So what are plus and minus? Dividend cash flow basis, plus is it considers cash flow. It considers cash flow. That's a bigger advantage compared to other methods that we looked at. It looks at cash flows of the future, right? Second, it looks at time value of money. It looks at time value of money. You are giving value for time. Third, it takes the future patterns of dividends. Future patterns of dividend. If you have patterns of dividend mean 5 years you have a plan, 10 year another plan, all that is considered in your valuation basis. So it's a cash flow based valuation, time value of money considered, future patterns of the cash flows are considered. Minus. What is the minus of the method? The minus is dividend cash flow method considers only dividends, only dividend, which is a portion of total cash flow of the company. Dividend cash flow is not the total cash flow. It's only a portion of your total cash flow. So therefore, you need to understand that even though we use dividend method to value the company, it may not be representing the total picture. So it's more suitable for smaller shareholder, minority shareholder. It's not for the person who is trying to buy the company, controlling stake, 20% stake. this method may not be the relevant method. It would be a good method for small shareholding people. You can take the dividend cash flow method. Minus, according to the dividend growth model, to use the dividend growth model, to use dividend growth model, what we looked at, to use the dividend growth model, your R has to be more than G. R has to be more than G. Your required rate of return of the investor should be more than a growth rate. If it is not, you will get a minus value. In valuation, please note, in valuation, you don't have a minus value. The lowest value you can get in valuation is what? Zero value. Zero value. So please note, R has to be more than G. R has to be more than G to use the dividend growth model. So that's another limitation of the dividend cash flow based evaluation. Third, if you are using two-stage model or three-stage model, what we looked at, the stages of growth, difficult to estimate. You are not sure that how the cash flow will be, dividend cash flow will be generated, first 5 years how it will be done, after that how it will be, because it is all future related. So future related forecasting may not be easier, right? It's not. It's practically, if you look at today's context, even 1 year forecast is very difficult to forecast by companies. They cannot budget and say how much budget profit, how much revenue they are going to make. They can have a budget, but may or may not be succeeding because the scenario, the environment has changed totally. So in that case, you deciding 5-year dividend pattern and 10-year dividend pattern, very, very difficult. So this is the limitation, stage of growth, difficult to estimate for two-stage method or three-stage method. So please note, these are the pluses and minuses of dividend cash flow method. Then in terms of dividend, please note, if you have taxation for dividend, from investor point of view, when you are valuing from the investor point of view, always remember to take net dividend, that is net of tax. Net dividend, that is gross dividend minus tax. So you take net dividend to value the dividend based valuation. You don't take the gross dividend, you take the net dividend. So keep in mind, because you are valuing from investor who is the one who is going to get the dividend, so net dividend is relevant for him. Then moving on to the other method, which is called free cash flow method of valuation. Free cash flow method of valuation. So if you take the chapter 5, the free cash flows is given in page 114, 115, and 115, free cash flow, page number 114 and 115, just giving you some idea about the free cash flow method of valuation. Actually 115, 116, these all talks about cash flow basis of valuation. So can you please take that? So free cash flow. What is free cash flow? This is the cash flow available freely to the investor. In any company, you will see the company had made profits and they will have cash flow. Out of that cash flow, how much is available freely to the investor. So the investor can be a shareholder or it can be debt holders. That means a person who has given loan funding. So those investors, the cash flow can be available. So this free cash flow based valuation, properly speaking, there are two free cash flows. One is free cash flows to equity. The other one is called free cash flows to firm. So there are two types of free cash flows, free cash to equity, free cash flows to firm. Firm mean equity holders plus debt holders. This is of course only equity holder. So there are two types of people who can be in the company, investors, free equity holders and debt holders. So these cash flows can be two types. Available freely to investor. So freely available mean You will say, for example, you have a profit after tax, simply if you take, and you have depreciation. Profit after tax, and you add back the depreciation, then it's about your cash flow. This is your cash flow, profitable cash flow you have in the company, profit cash flow. From this cash, you cannot distribute to shareholder as it is. Why? You may want to keep some cash for investment in capital expenditure and working capital investment. You might want to keep some cash for capital expenditure investment for next year and working capital investment for next year. So if you want to keep that money from the cash flow you generated, you reduce that cash flow. Further, you might see that your repayment of loans. Your company wants to pay loans outstanding, so you pay the loans. From the cash flow, you pay that repayment. So this is a profit cash flow. From that, you minus the investment in capital expenditure, investment in working capital, and repayment of loans. After all that, whatever the net cash flow, that is what available for whoever the investor. Mostly it's the shareholders. Depends on the cash flow type you are talking, you will say net cash flow. So these net cash flows are the one which is going to be available to the investor on a future period. So every year you will have to find out how many net cash flow as an investor I am entitled to. It's not a dividend cash flow, it's a freely available cash flow. It may be distributed or may not be distributed, but that's available in the company. So we will have to value the company, using this freely available cash flow. Depends on the valuation method we are looking at on the free cash flow. You will take the net cash flows and you will discount for the valuation. So under free cash flow method, if you are talking about free cash flows to equity, your market value equals to free cash to equity and the market value. What you are going to look at, your year 1, year 2, year 3, like that it goes to infinite period. So you will have free cash flows to equity, you will have it for all the years. So what you are going to do, market value equals to present value of free cash flows. Market value equals to present value of future cash flow, which are the free cash flow what you are going to get. So you will have year 1, 2, 3 till infinite period. Whatever free cash flow you have, you discount, then you calculate your present value. You discount and calculate your present value. So please note, this is the method of valuation. Most of the time you will have to do when you are going to talk about takeover or acquisition. If you are going to buy a company, or you buy a controlling stake in a company, or you are going for a merger, this is an ideal method of valuation. And as I mentioned, it's again goes on the basis, all the cash flow basis of valuation goes on the basis present value of future cash flows equals to market value. Present value of future cash flow equals to market value. So even here, you calculate your free cash flow, what you looked at earlier, the model of calculation, year 1 to infinite period, discount using whatever the discounting rate. Please note, if you take free cash flows to equity, there is another one called free cash flows to firm. This free cash to equity belongs to shareholders only. This cash flow, free cash to firm, belongs to shareholders and debt holders. Shareholders and debt holders. Debt holders mean the people who gave money on the interest bearing instruments. It can be debenture holder, it can be bank, anybody who are debt holders. This cash flow belongs to them. So you are discounting at, since its cash flow belongs to shareholder only, you discounting using cost of equity. Since these cash flows are belonging to shareholder and debt holders, you can discount using what? WACC. When you discount, you get the present value. that is the value of equity. Value of equity. That's your valuation. Value of equity, it's a valuation. This is the present value, which is the value of equity plus debt. Value of equity plus debt. So please note, there are two types of cash flow we can look at under free cash flow. Free cash to equity, free cash to firm. Free cash to firm belongs to the shareholder and debt holders. Free cash to equity only belongs to shareholders. So you discount using cost of equity and get the market value of the equity. Firm cash flow belongs to shareholder and debt holder. So you discount using WACC and get the present value which is the value of equity plus debt. So please note that there are two types of cash flow, and based on that you can calculate the value. Even using free cash to firm, you can calculate value of equity plus debt. Value of equity plus debt. After you calculating value of equity plus debt, you might get a value of equity plus debt, whatever value. You minus value of debt. Then what you get? Value of equity. So even if you use the firm valuation model, what you get is value of equity plus debt. From the value of equity plus debt, you minus the debt value and we get the value of equity. So please note that this is the ways of calculating shareholder value under two bases of a free cash flow. Okay, please take down this. Then when you look at free cash flow models or free cash flow to equity or free cash flow basis, plus and minus. What is the plus and minus? Free cash flow based valuation is the comprehensive method of valuation. Compared to all the methods that we talked about, this is a comprehensive method. Why we call it comprehensive? It looks at entire company's profitability and cash flows and strategies of the company for the future. So you look at not just the earnings, you look at the cash flows, which includes or which consider the profitability of the company and the strategies of the company. Strategies of the company mean how you are planning to invest in working capital, how you are going to pay the loan repayment, all that in your cash flow you are considering. So comprehensive based valuation because it considers entire company profit and cash flows and strategies. More importantly, it considers time value of money. So this is a very what you call appropriate valuation for any company. Minus free cash flow method, difficult to get information. You may not be able to value a company just because the company listed in the market. You cannot value that company using free cash flow method. Unless you are going to buy that company 51% or some significant stake, you may have to write to them or you have to go and meet them, you have to tell them that you are going to be interested. Then you have to do it valuation on that basis professionally. Then you might be getting all the information. But as just a normal ordinary person outside the company, you cannot value this company using free cash flow basis because no one is going to give you the future cash flows of the company in first place. You can look at the balance sheet and income statement of the company today, not the future cash flows or profit or profitability or any strategies of the company. No one is going to disclose that information. So unless you sign a non-disclosure agreement with the company, these informations are not possible available in the market. Second, there are a lot of assumptions made. You are going to make assumption based on the company going to invest so much, the company cash flows is going to be so much, and their dividend plans are so much. These are all future estimates. These are all assumptions. And cost of capital will be so much. All these you are trying to plan, just estimates or guesstimates you are going to make, which is not, I would say, not practical sometimes, and you are just putting numbers to get the value of the company. So this is assumption made basis, so there is a minus on that base. So please understand these are the minus of free cash flows, but otherwise it's the best method of valuation to value any target company where you are interested about controlling stake or even to buy a significant stake in the company. So when you look at different methods of valuation, we started from net asset basis, then we talk about PE method of valuation, then we talked about cash flows, and the cash flow we said there are dividend cash flows, and then we talked about free cash flows. Dividend cash flow, free cash flow. Dividend cash flow, again we talked about three methods: constant dividend, and then constant growth in dividends, and two-stage or three-stage valuation model. And free cash flow, again we looked at free cash flows to firm, free cash flows to equity. Now these are key methods. There is an earning yield method, which is just a formula based calculation. It's not very much effective method of valuation, but if you take, these are the methods we will use in practical case. Now tell me, what is the one going to be more appropriate and what circumstances? If you are talking about a minority shareholder, the shareholder is a minority, he is only owning 10,000 shares, or if he is interested in buying 10,000 shares, what is the method more relevant? I would say the main method will be dividend cash flow method. Minority shareholder, he is not interested about the total company or controlling stake, so he doesn't want to worry about free cash flow. He can use the dividend cash flow method and value the company. Then somebody who is trying to feel that company as non-going concern. What is the method? If anyone is going to value the company using a non-going concern basis, what is the method of valuation? Ideally, I would say net asset based valuation. Because non-going concern means you are going to value the company based on today's assets and liability. Based on today's assets and liability, how is the value of your company? You just take the today's assets and liability in your balance sheet and see value of the company without looking at any future cash flows, future strategies, nothing. Simply you take net assets. So net asset basis would be mainly looking at a company not at going concern basis. You are not looking at going concern basis. You are thinking that, okay, if you close tomorrow, what's the value of this company? So you just take this as a minimum guaranteed value, how much the value is, not the futuristic related. And if you are talking about controlling stake, anybody wants to buy controlling stake or significant stake. Controlling stake or significant stake. Controlling stake and significant stake, you have to use one PE method, other one free cash flow method. PE method and free cash flow basis. So these are two methods are more relevant for a person who is to value the company for controlling stake, that is 51%, or 20-30% significant stake. You are going to value the company, use this PE or free cash flow basis. So please note that different methods of valuation more relevant to circumstances. Okay. Then, if you are going to value a company using all these methods, use the net asset basis, PE method, and the cash flow basis, you are using all methods. So controlling stake of a company, you use different methods. So you will see that you will have net asset basis say 100 million, and your PE method says 150 million, and free cash flow says 200 million value. So what is the value of this company? Same company, different methods of valuation, different values. So what is the value of this company? Please note, you are talking about buying a controlling stake in the company. Net asset basis gives you 100 million, PE method gives you 150 million, free cash flow gives you 200 million. So now as an investor, you need to decide what's the value. Please note, whenever we are going to buy a controlling stake, we have a buyer, we have a seller. we have buyer and seller. That means the investor is a buyer. The other side, there is a shareholder who is significant shareholder who sells the shares. So there is an investor who is buying, there is another investor maybe, he is selling the shares. So a buyer and seller. Buyer always wants to buy the shares at a lower value or higher value. Any buyer, any item of asset you are going to buy, do you want to buy at a higher value or lower value? As a buyer, you want to buy anything at a lower value. Seller, always he wants to sell any item at a higher price. So we all know that the company will be, or somebody will be buying the shares, interested in buying at a lower value. Somebody will be interested in selling the same asset at a higher value. So if you take these methods of valuation, assume that both company, buyer and seller, as a chartered accountant, right? Both have valued this company using different methods of valuation. So buyer also have a chartered accountant, he also has three bases of valuation, seller also has a chartered accountant having 3 bases of valuation. So what is the value? So you need to now decide what is the value we are going to offer. As a buyer, you will start from where? As a buyer, where do you start? Right? You have 100 million, 150 million, 200 million. You want to give a lower value. So you might start at lowest at 100. But as you know, in corporate world, no one is going to sell the company based on net assets. Why? The company has future plans, future cash flow, future potential, all that. So therefore, it's not your balance sheet books of assets and liability. It's about your future cash flows, future assets, future plan, future strategies. Therefore, this 100 million is not a value. Even though you might think it's a starting point, but it's not the right price to start with. You can start, but then seller may not be interested even to talk to you. So better you will start somewhere around 130 million, 140 million. You will start at 130 million, for example. It depends. Seller, he wants the highest price. So what is his offer price? 200 million. So seller's offer price 200 million. Buyer offer price, or the offer price is 130 million. So these two transactions or these two offer information will not tally. So no transaction takes place. So then what happens? They both negotiate the price. They negotiate on the table and look at their pluses, minuses, strengths, weaknesses. Both will discuss various things and say your company have these products, these are not marketable, the people don't buy it, so we don't have value on that business. Or you have a land and building, even though you say this is a building has a value, but as a business we don't see the value in that building. Or maybe you have a plantation, that plantation are not efficient in the past, so we can't make money out of it. These are negatives you might talk about. The other side, the seller will say, no, we have a brand name, any product we offer to the market, people will jump and buy those goods, so you have enough demand in the market. Or maybe you have very good distribution channels which nobody has in the market, so we have advantage. Or maybe we have good employees, senior most employees in the company who are well experienced, they are technologically driven people, they know what to do, what's to be done. So you can't find those people in the market. So there are plus minuses, both parties will talk in the negotiation table. So finally, they will come to a decision, okay, 130 million, you will increase to 150 million. He will, if it is interested, he will bring it to 175 million. These are just a negotiation. So finally, if both parties are really interested, they might say, okay, fine, we will do it for 160 million. This is a hypothetical case I am talking, right, how the transaction could take place. Any point of the negotiation, if one party doesn't want to come down on his price or he doesn't want to change his price, this transaction is out. There's no question about transaction. But otherwise, if both are really interested in buying and selling, they will negotiate much as possible to come to a point where seller also feels I have won the transaction, buyer also feels that I won the transaction. That is where the equilibrium price or the reasonable price is fair price is agreed upon between the buyer and the seller. So please note that these are the methods of valuation, only a guidance, only a guidance. There is no right value, there is no wrong value. If you are learning valuation chapter, the valuation whatever we are valuing is only a guidance for the negotiation. This is not the value. If anybody say, no, my value 100, 100 is the right value. No, there is no right and wrong value. Here, these are the methods of valuation, gives us some guidance of the values. It has its own reasonable assumptions and basis, which is justifying the value. When you go to the negotiation table, both parties will negotiate and come to agreement what is the reasonable value for them. So please note, this is not the right value. This is only a fairer value using different bases, and when you negotiate, each and everyone will come to an understanding that, okay, I should pay not 130, I should pay more than that. Even the seller will realize 200 million is more optimistic valuation base I have used, which may be depending on the future cash flow, future estimates, future cash, what you call the earnings and the business environment, taxes in the government implied in the future, all that depends, if condition. So I better reduce the price to reasonable price. So he will bring down the price, you will increase the price, finally you might agree on a price, both parties finally mutually agreeable. If you don't come to an agreement, this transaction is out. So please note, this is this valuation. This is the valuation. So you cannot say that X amount of value is the company value. If anybody is saying that, you are wrong. You are only getting guidance from different methods of valuation. It's only giving you an idea. Based on your explanation and negotiation, you have to establish. Sometimes some negotiation fail. You are maybe aware in the past there are certain banks were trying to merge together. The transaction didn't take place. Why? The negotiation would have failed. Simple. But there are enough transactions happen in the market where people agree to buy, agree to sell. That can happen. Because both parties needs to have a reason to buy and sell. This person needs to have eager to buy. Somehow I want to buy this. Same time the seller also wants to sell this. Somehow I have to sell it. If that is there, they will come to some negotiation table. Otherwise they don't come to negotiation table. So please keep that in mind. The other important thing, in the stock market, there are a lot of companies are valued using different methods, and people do the transaction. People do the transaction. The required rate of return of the investor, required rate of return of the investor is an important information which will determine the value of the share. So even if it is a dividend cash flow method, same company, for example, say John Keys, if you are talking, same company if you are going to value using dividend cash flow method, you will have the same cash flow, year 1, year 2, year 3 till infinite period, you have X amount of dividend, X and Y and Z, you have dividends. So what is your basis? Market value, X div, you say present value of future cash flow, present value. In order to calculate present value, you are using a required rate of return of the investor. Whether the required rate of return of the investor is the same for all the investors. In stock market, there will be thousands of investors. All thousands of investors, are they going to have the same return requirement? No. X will have return requirement 15%. Required rate of return, X required rate of return 15, Y required rate of return 20, and maybe B will require 12%. So these are required rate of return. Same cash flows, but required rate of return differs. So please be aware, the required rate of return decides the value of the company. If your required rate of return is 12, you will get a different value. When your required rate of return is 20, you get a different value of company, even though same dividend cash flows you might have in the company. Because John Keys will pay the dividend to every shareholder same amount. But each shareholder will value the dividend shares at a different value. Why? Because his required rate of return is different. So please note, required rate of return of the investor is a key thing in deciding the market value of the share. And on the same thing, remember, required rate of return of the investor, I repeat the word investor, and market value, and the market value of the share, there is a relationship. What is the relationship? This is having a negative or inverse relationship. Please understand, It's a negative or inverse relationship, which you mean recurrent rate of return increases, that means the investor return requirement increases, your market value comes down. Return requirement comes down, market value goes up. It's opposite direction. Why? Your formula is what? Market value equals to D divided by R. So when the R is increasing, that is recurrent rate of return, your market value drops. It's opposite direction. If you take the dividend growth model, you have DO1 plus G, R minus G. Where the R recurrent rate of return increases, market value comes down. You can put any numbers and double check your numbers, see whether that value comes down. So relationship has to be known to you. Please make a note of this, because this is something as a knowledge you should have. When the return requirement investor increases, same company share, market value drops. Recurrent rate of return reduces, market value goes up. And if you take today's context, government has reduced almost all the interest rates in the market. So now you know that 12-13% interest in the market have become 6 to 5% rates. So interest rates are 5 to 6%. So what happens? Your recurrent rate of return as an investor has come down. You cannot expect 25% return in the market. Why? Your market bank interest rate is 6%. So your return requirement will come to 10 to 12%. You can't expect from the share market, just because there is a risk, you can't expect 25%. Your 6% bank rate, so you will say 10 to 12%. If you are taking a 10 to 12% return requirement compared to earlier 20%, your return requirement comes down. Recurrent rate of return comes down. When it comes down, market value what happens? Increases. Share market goes up. So you would have seen that from last few months, after the corona, the market started in May 11th. From May 11th, the market has gone up. So with this present condition where the interest rates have been brought down, the expectation is market will further goes up. Why? Expectation of return of the investor comes down. He can't expect 25% from the share market. He will expect only 10 to 12 or 15%. So if he has reduced the interest rate requirement or return requirement, his market value comes down or market value goes up. So it's opposite direction. Please note this. It's a negative relationship. Recurrent rate of return and market value have a relationship which is inverse or negative. Then, so those are just to brief you on the valuation basis whatever we have looked at. So you could go to the chapter study pack so that you get an idea. With that, I wanted to touch upon some of the important factors which influence the share prices in the market. All of us know that in the stock market 290 odd companies are traded. 290 companies are traded. The share prices daily basis goes up and down. If you take last few days, the share price has been going up. Same time, if you take previous weeks, the share price would have come down. So it's a up and down in the share market. So these share prices are moving. Why some company shares are going up, some prices are coming down? Why? What's the reason? So there are factors which influence share prices. I would broadly put into one, macro factors. Second, industry factors. Third, the company factors. So one, macro, two, industry, third, company. So there are various factors. You can write many number of factors which influence or determine or affect the share prices in the market, stock market. Macro factors. What are macro? Interest rate changes. You would see that interest rates are going up. That's what I explained earlier. Interest rates are dropped. So there is definitely an impact on the market prices of all the shares because there is a positive impact. Then you have exchange rate impact. Exchange rate changes. If the dollar rate 182 become 200 rupees. If 200 rupees, share market have an impact on the prices. Exchange rate impact. Taxes. Presently in Sri Lanka we don't have capital gain tax. So the share market shares are traded where you make profits or gains, that gains are exempted. No tax has to be paid. Assume that government introduces a tax, 10% tax on capital gain. What happens? Share market comes down. Share price get affected. So that's a macro picture. So macro impact. Fourth, SEC or CSE regulation changes. SEC or CSE regulation changes. If the SEC or CSE regulations are changed, there is impact on share prices for the entire market. Not one share, two shares, entire market get affected. Then political. The political impact to the stock market. If you have a government where you are not politically stable government, there is ups and downs in the share market. Very much, because people are not sure about what's going to happen. But when you have a stable government, there is some direction, some policy direction. People know that this is the way we are going to go in the future. So there is a stability in the political side. So there is an impact on share prices in the market. Then you might maybe security risk, right? In 2019, we went through the security risk, where the security, we are threatened by certain things in the country, so we were scared about it. So there is impact on the stock market also. Share price will come down negatively. So these are the macro factors. Industry factors. These are specific to industry. Government might introduce new taxes for certain industry. For example, if they introduce a tax for, say, telecommunication levy, that only affect the share market, telecommunication company. Telecom, Sri Lanka Telecom and Dialog will affect their share price. Their price will come down when there is a new taxes. Then you might see that some concessions are given. Concessions are given to certain industry. If the government say, okay, tourism sector is badly affected, we are giving a concession of certain benefits. No taxes for next 2 years. If they give that no taxes for hotel sector or the tourism sector, the share price may go up. Why? There is a positive impact. So please note, anything happening to certain industry, that industry company's share prices will change. Other thing is motor vehicle imports. Now, as of you all know, till December the motor vehicle imports have been cut down, or basically government doesn't want you to import vehicles at this moment. So that has an impact on motor vehicle companies. Only the motor vehicle company, not the entire stock market 290 companies, only motor vehicle companies which are in the motor vehicle import business. So these are certain examples to say the industry factors that is only specific to one industry, you have impact. Now, if you take certain times the bank introduces or banking sector, new rules are brought in. Government brings new rules for the banking sector. So banking sector get affected. So these are only for industry. Company. Specific to company, there are various factors. It's starting from your dividend announcement, new project announcement. You might have a new project announcement, and you might go for right issue, and you might have a splitting of your shares, and your company board or management change, and your company agreed to go for merger or acquisition. Your company has decided to go for a merger or acquisition, and your company has gone through a fraud. And your company have a strike, and your company announces the profits. All these factors you can add on further. All these factors are specific to a company. So those specific company share prices will change up or down, depends on the information. So please note, these are various factors. One, we talked about macro that impact the entire market. 290 company get affected. These are the one examples. Industry, these are the specific industry you might have an impact. These are factors which will impact specific company. So now you have to understand daily basis in stock market, share prices are moving up and down. Why it's moving up and down? These all are reasons. It's not one reason. Sometimes same time it happens. Interest rate change happens at the same time. One company would have announced profits. One company board would have changed. Or that company would have crashed. Somebody has bought over another company. All happens together. So all these can affect the share market. So whenever we think that share market price has gone up or gone down, don't ever think it's one factor. It's not one factor. Many factors together impact the share market. So share market going up or down, your reason could be many reasons. It can be macro reasons, it can be industry specific reason, it can be company specific reason. So please note that these all are reasons. It's not in the study pack. It's basically the environment related I am explaining, so that you should be aware that stock market up and down, why it's happening. Why it's happening. There are a lot of reasons can be there, right? Lot of reasons. I can write another 2-3 pages of each and everything, but please understand these all have an impact on share prices. Sometimes it has a simultaneously happens. Okay. So in valuation, one of the things you need to remember in our chartered study pack or the what you call revision, whenever you do, you realize that the valuation chapter plays a major role. Why I say that? Even the other chapter, when we go to look at these cost of capital or capital structure or mergers or acquisition, all these chapters have some linkage to the valuation chapter. Especially the concept of present value of free or the future cash flow. Present value of future cash flow is the value of the company. You need to keep this concept or logic very clearly to you. Present value of future cash flows equals to value. Any asset value you can calculate by calculating present value of future cash flow. So if the future cash flows are reducing, your value is dropping. That's why we call it in financial accounting impairment. Impairment standard is about that. So when you say the future cash flows are dropping in any investment, that means your value is coming down. So if you take the future cash flows, what you have forecasted year 1 to whatever period, year 15 or whatever, you have 100 million cash flow you have forecasted for the entire 15 years. That 100 million cash flow, if it is for some reason falling into 80 million, you immediately should know your value will be dropping. That is the impairment needed why your cash flows have dropped. So please note that wherever the organization cash flows are dropping, obviously the value will drop. And especially today's context under COVID-19, there are a lot of companies go through difficult times and they are going through a very big challenge of what's going to be the future cash flows or future income, future budget. So the future cash flows at time being, it's all bit of a uncertain levels. It's not very confident. They say, okay, this is the same cash flow we will generate like last year. They may predict, but may or may not be able to achieve, because we never know that what's going to be the next future time period. Because in the entire world is going through this difficult time, recession. So the cash flows may not be the way we have forecasted. So if that cash flows are falling, obviously your mind has to tell you the cash flows are falling in the future mean my value is coming down. That means I need to make an impairment. So the share market also, you will see that if the cash flows are not very much confident in the future, your value of the company will come down. So I think with this COVID announcement into March and later part, the share prices drastically came down because of the COVID-19. But now, since we as a country, we are developing or we are getting out of that issue slowly, you will see that there the positivism came. So the cash flows are better than what you have estimated earlier. So the now valuations are going up. That's why the share markets are going up. So you have understanding now, the value will go up, depends on the cash flows. If the cash flows are going up, the value will go up. If the cash flows are forecast to be going down, the value will drop again. That is based on present value of future cash flow. So I think that basically covers the valuation chapter, right? So as I mentioned, you could go through the study pack chapter 5. It has few examples. Please go through that study pack. that will give you the idea about what are the methods what we have talked about, and then you may have to look at the past paper questions as well as revision kit that will support your understanding. Okay. So thank you very much.